Hi, Ben Smith with Cove Financial Planning. Spring is here. It seems like stock market volatility is in the air, so let's talk about it. I want to talk a little bit about what's happening geopolitically, in what, at least historically speaking, what the stock market has done following these concerning events. So a couple of quick charts to share with you as we kick off the spring season. The first is a quick breakdown of similar, not identical, geopolitical events that could look and feel like the Iran war that we're in now. And importantly, the stock market returns just before these events and just after them. And you can recognize some of these things: the Cuban Missile Crisis. We have some political assassinations, 9/11, Iraq War, Russia, Ukraine, etc. The point I want to make here is if we track the stock market returns after these events began, in the 3 years, these are average annual returns. In the 3 years after the start of these events, the market has always been up. And in many years, up in a significant way. We see a lot of double-digit average annual returns in the 3 years that follow. I'm not here to say that the Iran war is exactly like what we've seen before, but it's almost like we've seen this play out before. We've seen oil prices go up before, and the market tends to, shoo that aside, at least in the long term. Here's another quick look. This is just a chart of the stock market amidst all of these, geopolitical and other concerning headlines that we've seen. And the point here is that the market has never not recovered. I don't think this time is any different, at least for those of us that have sort of a longer term orientation with our investments. Oil prices, I get it. That has been a concerning headline as well. This tracks the daily returns in the U.S. stock market, oil prices and gold prices after the geopolitical events that we've talked about began. And you can see oil prices tend to spike after things like this happen, especially in the Middle East. A little choppiness with the U.S. stock market, but in all, you stay invested long enough, the market tends to reward those that sort of keep the blinders on. I think this time is no different. Final chart here. This is a chart explaining the cost, the opportunity cost of being out of the market, like moving to cash, for example, in a short period of time. So if we go back to 2001 and you invested $1,000, you just put $1,000 in the Russell 3000 index, diversified U.S. Stock market index. Fast forward to the end of 2025, you'd have about $8,300 saved. But if you moved to cash, if you missed out on the best 1 week of returns in that roughly 25-year period, you'd only have about $7,000 remaining. Similarly, you missed out on the best month, you have about $6,600 remaining, so on and so forth. If you missed the best 6 months, you'd have significantly less, about $5,400 in your portfolio relative to about $8,300 if you simply stayed invested. So I sound like a broken record here. I say it all the time. If you have your long-term mindset with investing, longer-term goals that you're working towards, don't let this noise influence your investment decisions. I know it's easier said than done. We'll talk about it during our spring review meetings. But with that, let me know if you do have continued concerns or any questions I can answer. Always here to help. Thank you.